Well, Kelly, Phoenix-based Taylor Morrison did report better than expected earnings, but new orders were down 25% as the housing correction now really takes hold. Joining us is CEO Sheryl Palmer. Sheryl, thanks so much for being here. We are obviously at an inflection point in the housing market, a correction point, and less than an hour from the Fed announcement on interest rates. In your view, is the Fed making the right moves given this impact on your business?
Yeah, I think the Fed mandate, Diana, has been quite clear. And certainly with housing being such an economic driver on the inflationary pressures, housing is going to feel this. I think that the Fed is acting very swiftly. I think that we all expect to see an additional 75 basis points today. And I think the sooner we move through this, honestly, the better we are.
Now, your cancellation rate jumped, nearly doubled almost, so it means you're sitting on a lot of supply right now. How are you going to deal with that going forward? Are you going to have to lower prices? Obviously, you're doing incentives, but will prices come down?
So Diana, I think to start with, when you look at our cancellation rate, I think looking at the year-over-year number or increase is probably the wrong baseline, because even at the second quarter cancellation rate that we reported today, this is still so much lower than historic averages for as long as I've been in this industry. So honestly, when I look at our 10%, 10.8% cancellation rate, I feel really good, especially when that's like 3% of our starting backlog. We've actually taken a very proactive stance with our backlog and, being in touch with all of them, helping them understand kind of the financing options out there and going ahead and getting them locked. In fact, I would tell you that we have a higher percentage of our back half already locked than I've ever seen before. As far as incentives on the sales floor, Diana, we have really focused. I spent a lot of time this morning on the earnings call talking about this, but we've really focused our incentives on working with our customers to get the benefit of good financing. And so we haven't made really any pricing adjustments, but instead we're working with our customers and tailoring to their needs. Generally, the impact that they're trying to overcome is on monthly mortgage payment and cash to close. And by using our incentives to tailor it to their individual needs, we're able to address both of those items.
And let's talk for a minute about your stock. It's obviously rebounded nicely in the last month, but you're still down 20% year to date. What are you telling investors now going forward?
When you look at the way the industry has been valued since the beginning of the year, clearly there's some uncertainty, no different than what we're seeing with the consumer on what do all these inflationary pressures mean. If you look at the historic playbook, when interest rates move up, generally sales slide. So I think that's what's getting priced into the builder stocks. I think as soon as, once again, we can get some confidence and some certainty and not the level of volatility we've seen, I think that will serve us well. You know better than I do that there is not a direct one-to-one correlation with Fed fund rates and mortgage rates. But if you look at what's happened to date, we're seeing mortgage rates that have moved so much, higher, almost 2 times higher than the Fed funds rate. So when I kind of look historically, and I think generally that's only about 40%, I think most of this is priced in, Diana, and we'll start to see some settling. And I think all projections right now are saying next year we could see those rates start to come down a little bit as well.
Sheryl, it's Kelly here. What's the worst case scenario that you're currently prepared for?
I think we look at, and doing sensitivities all the time, we look at volume. I think as the consumer adjusts to today's environment, it's really understanding what the volume implications are. Right now, inventory is very low. I would say when I look across all of our markets on the resale market, we're averaging like 1 month of supply. That's still so low by any historic standards. If we see that continue to move up, I think that would, we'd have to reevaluate and look at pricing and our strategies. Same on the new home market. There's really no completed inventory across our markets. We reported this morning, 60 completed inventory homes on 320 communities. And that's pretty consistent across the peer group. So I think we just all have to keep a very close eye on inventory and new communities that are coming to market.
And Cheryl, just finally, what about lumber prices? We're seeing them down 16% just this month, 50% already this year. Is that helping you in being able to price a little better and with other supply chain issues also easing up?
Yeah, absolutely. It's nice to see some relief on the lumber side. When we look at the second quarter, we actually had some pretty nice support, which really did help our record-breaking margin that we announced this morning. When we move into Q3 and Q4, as far as our closings go, it's a bit of a headwind. But as we move into next year, it should provide us some additional tailwinds because, as you know, we saw lumber, move to the 1,700 range last year, and now it's out there trading, probably in the high fives. So when we look at new starts coming in the ground, absolutely that's considered in our pricing as we look into next year's deliveries.
Cheryl, thank you so much for joining us. Cheryl Palmer, CEO of Taylor Morrison.